Good afternoon, everyone. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. I want to welcome you to this week's Mortgage Minute. And we're starting to wind down November, heading into Turkey Day next week. So I want to give you an update on what's going on in the mortgage and financial markets. As you know, we like to start off with giving you an idea of where mortgage rates are at. Interestingly, they're pretty much settled in this fairly narrow trading range. As you can see here, as Jeff pulls up our rate grid, we're still right there in the mid sixes, slightly above 6.5, 6 5/8 for 30-year fixed conforming. Those buy downs, 3 2 1s, 2 1s, right around that same 6 5/8 note rate. But you can get a first-year rate in the 3s or 4s, depending on which buy down option you choose. FHA is hanging in there right at around 6, 5.99, VA just over 6. So we're kind of just settling in at this level. The one thing I'll note is the equity loan rates are actually looking pretty good right now, and in fact we'll touch on that a little bit later. And also want to remind everyone, if you're new to looking at the watching this program, is take a look at that link at the bottom about mortgage rates, where I give you a pretty good explanation as to how mortgage rates are determined. So that'll give you more insight as to why rates are where they're at. And of course, we'll also let you know that it's not all about the Fed, as a lot of folks still continue to believe. But with that, let's go ahead and go to what is the best indicator of mortgage rates right now. And actually, just generally speaking, mortgage rates are all about the bond market, not the Fed funds rate. Here's the chart of the 10-year bond. We always like to try to pull this up, give you a chart of the last 5 days. And you can see that actually it was a little bit elevated earlier in the week. And then as we got into midweek, in fact, there's that dip that Jeff likes to point out, that he thinks we often see a midweek dip in the 10-year bond yield. So this week it's there. Last few weeks, not so much. Again, I covered that a while ago, where I concluded that there's really no correlation between a Wednesday and bond yields dipping per se. But this week we did see that a little bit. But overall, it's relatively flat. We've been hovering between, say, a 435 to 445 10-year bond yield range now for really a couple of weeks. Let's go ahead and go into what's going on in the financial markets to help determine where these bond yields are right now. And you know what? It's all about light. Very light economic calendar this week. Very few economic data points that would tend to move the bond market. So partly probably when we're heading into the holiday. So as a consequence, as you can see on the chart here, really the only couple of things to talk about is the housing sector. Some of the major data that did come out this week, starting with housing starts, 1.31 million is the number. That's the forecast, and it came in at actually came in at 1.31 million. Forecast was 1.34 million, so slightly below forecast. Building permits, same thing. Forecast 1.44 million, came in at 1.42 million. This is being attributed to basically both of these numbers are 3-month lows, and having to do with higher rates and hurricanes, causing a little bit of a drop in both permits and starts. And we'll touch on this on our next segment when we get into a discussion about the housing market as to what's going on there. But there's really a continuing issue with building enough homes, and I think this data underscores that is still a challenge in the financial markets and in the housing market overall. Existing home sales, 3.91 million was forecast. 3.84 million was the number in September. Well, that got released this morning, came in slightly above forecast, 3.96 million. So of course that was looked at as like a good news, and of course it is good news, but yet still we're at a below 4 million level for existing home sales. That is down quite a bit compared to what it was. Just back during the pandemic years of 20 and 21, it was more like 6 million plus. So we're off by at least a third in terms of existing home sales. And again, that's a national number. And then basically the only other data point coming out this week will be tomorrow, the Standard & Poor's U.S. Services and Manufacturing Purchasing Managers Index. Both of those are forecast to be slightly above the previous month. And of course, if that turns out to be true, that becomes another sign that the economy is hanging in there pretty well. It's growing pretty well. The signs of a recession coming are not quite there yet. And of course, that would be a reason why the Fed is taking a slower approach when it comes to reducing the Fed funds rate further. Now, the Fed funds rate um, reduction of 1/4% that is still on the table for December, that is expected to happen. But then come January, it's widely getting to be expected that the Fed's going to hold steady and maybe not do another cut right away. So we'll just have to see how that plays out. Ultimately, again, Fed funds doesn't directly correlate to mortgages. It's more of a building block. But yet, if they are going to hold steady, that would probably prolong the period of time that we're going to have mortgage rates and bond yields at the levels they're currently at. That's why we like to say on interest rates are going to be higher for longer. If you're waiting around looking for a below 5% mortgage rate, that's not in the cards. I would say anytime soon. Next week, about the only data point of consequence is the PCE, the Personal Consumption Expenditures Index. That comes out actually next Wednesday, the day before Thanksgiving. That is really the Fed's favorite inflation target. So that'll be interesting to see what that number is, particularly given its release right before the Thanksgiving holiday. That could either exaggerate any market move in terms of bond yields, or it might be muted just because there won't be a whole lot of trading activity, at least not normal activity, going right into that holiday weekend, that long 4-day weekend. So we'll see what that is. That's really the only data point next week that could move the market. So we'll see how that plays out. So with that, we're going to go ahead and go into our discussion segment. I attended a seminar yesterday called Market Watch. It's done here locally in my market in the Coachella Valley. And the title of the seminar was, Will Lower Rates Improve Home Sales? So we're going to talk about that a little bit and what some of the forecasts were in that seminar, both locally as well as nationally. So Jeff's going to come back so we can talk about a few questions. Hi, Jeff.
Hi, Art. How are you doing?
Doing all right. How are you?
Good. I was very kind of excited to see the number as far as existing home sales actually going above what their forecast was. That's potentially a good sign. Yeah.
Oh, yeah, it's good. I mean, it was a modest increase, but what we don't want to see it dropping further than it already is. So we'd like to really see that thing get over 4 million. And I don't know. I'm not sure how soon that's going to get there, but at least it's trending in the right direction, albeit at a pretty slow pace upwards. So,
well, before we get into today's topic, let me just ask that question. You've been around long enough to kind of weigh in on this and really have something to say. And my question is, what would it take to get it over 4?
Well, that's something we can talk about. I think, it's interesting because we still are dealing with this situation where the housing market is kind of locked up. Inventory, though, is growing. It's better than it was, but it's still not back to normal. And in order for home sales to really start kicking in, we need to see more existing homeowners, more of the current housing stock get on the market listed for sale. And, again, it's kind of inching toward that. Here in the local market we have in the Coachella Valley, where, it wasn't long ago, we were looking at like a 2-month inventory, 2 months of inventory based on the sales rate. That has creeped up now to over 4. It's still below normal though. So, and really in terms of getting more sales, at a higher level than that 4 million threshold, we need to see more houses hit the market. And of course, we do want to see some rates come down from where they're at. We were heading in that direction in mid-September, but we ended up getting a head fake. It's like we were getting down in the low 5s, mid 5s, and then suddenly, boom, the Fed announces their reduction of the Fed funds rate, and not expected at all, mortgage rates went the wrong direction. So that, I think, kind of put the brakes on, the direction we were heading. And so actually what's going to be interesting is to see what the existing home sales number is going to be for the next month, given this, this run up in rates back to these current levels when we were literally 1% lower 6 weeks ago, 8 weeks ago.
Yeah. All right. Well, let's get into today's topic. You said you were at the meeting yesterday that was very in-depth and informative. And I guess my first question is, what were your takeaways from your meeting?
Well, the first thing I would say, one takeaway in this Market Watch meeting that was conducted here in the Coachella Valley yesterday, is something I've been talking about for a while. Home prices. Home prices have appreciated. They've appreciated at a slower rate. But one of the takeaways at this meeting is that we're probably going to finish 2024 with about a 4% appreciation rate in housing prices, both here in the Valley as well as nationally. So again, it underscores this notion that for those folks who are, maybe need to buy a home or want to buy a home, you've been waiting, hoping for rates to come down, hoping for home prices to come down. That waiting game has not worked in your favor. Home prices have appreciated this year, albeit at a slower rate. So that was one big takeaway. Then related to that, in this seminar, there was basically a forecast that home price appreciation over the next 5 years could be at a pessimistic level about 8% over 5 years. So, what is that? About 1.5%, 2% maybe, or more like 1.5% over, per year over the next 5 years. The strongest range or forecast was 20% over the next 5 years. Well, of course, that would continue a sort of what is considered somewhat of a normal 4% a year appreciation rate. So that was the range given, is that home prices are expected to appreciate further 8 to 20% over the next 5 years. And I think where we land on that range is going to be very much dependent on where mortgage rates go over the next couple of years. And that was the other thing that was a little bit surprising, and I think a little bit sobering maybe for some of the viewers here on this program. What was the forecast for mortgage rates? Well, guess what? For 2025, the forecast at this seminar was mortgage rates to hit the low sixes. Well, that's frankly not much lower than where we're at now. Again, we're at mid to high sixes. In fact, interestingly, I saw on the business news, they're talking about rates are in the sevens again for conforming 30-year fixed. We're not that high. We're actually in the mid, 6.5, 6.625, 6.75 range. But when you think about it, if the mortgage rates are predicted to be in the low sixes in 2025, that's not much of a movement for where we're at now. And in fact, the further forecast for 26 at this seminar was mid fives. Well, again, that's not much of a movement from where we are now over the next 24 months. And we were briefly at the mid five level in September. Unfortunately, it didn't stay around long at all, literally just a few weeks, and it's shot back up. So that was a pretty interesting takeaway, Jeff, both in terms of home prices and interest rates. Higher for longer, probably true on both home prices as well as mortgage rates.
I don't want to like sound like I'm just tooting your horn or patting you on the back, but you've been saying this for a long time. If you go back and look at any of the programs you've done over the last 12 months, I mean, you have predicted this almost on the mark and really encourage people to take action, especially when we saw that dip just a few weeks ago about maybe a month and a half ago, to take advantage of what was going on. And unfortunately, a lot of people didn't. So, my next question is, we've heard about this thing called the magic mortgage rate. And I know you said it in one of your programs, because I asked you, I said, hey, what is it going to take to kind of unlock this market? And so the question is, hey, what is that magic mortgage rate?
Yeah, it's a good question. And in fact, at this seminar, this was talked about. And what's interesting about it is the magic mortgage rate. When they presented this information, they were referring to actually a survey that was done by a company called John Burns Research. And apparently this research firm has studied the mortgage market, mortgage rates, and trying to identify at what point, at what interest rate level do we need to get to for the housing market to get unlocked. In other words, for the housing market, the current housing stock, to be motivated to go ahead and, if they want to move and they want to sell, cash in, what are we going to need to see in terms of a rate, that magic mortgage rate, to induce homeowners to decide to list their home for sale, to help us get that inventory expanded and address the pent-up demand that we have with home buyers. Well, what was interesting about the seminar is this John Burns research outfit identified mortgage rates need to be between 5 to 5.5%. And if that were to occur, that would mean potentially as much as 47% of homeowners would be motivated to sell. The idea being, well, if you're in the 2s and 3s now, if you do decide to look at selling, you're willing to do that knowing that if you're going to buy another house and have to get new financing, that if it's available in the 5 to 5.5 range, that's, yes, higher, but not so much higher that you would not be motivated to go ahead and make that sale happen and buy another. I'm not sure, Jeff, I agree with that. Now, I think we were heading in that direction in September, because again, we, MortgageWorks, we were in this range. We were at 5% for FHA, VA. We were at 5.5 for conforming 30-year fixed, but it literally did not last long enough to really see this unlocking of the market occur. So I'm going to disagree with John Burns' research. I'm sure they have the credentials. I think we're going to have to go a little bit lower than this 5 to 5.5 range. I think where the unlocking of the housing market is going to occur, we need to get to 5 or less. So I would say take that range and move it down 0.5%, 4.5 to 5. I think that's where we're going to see the unlocking of the housing market and see a whole bunch of sellers get on the market, and then that's going to be something that these home buyers can go after and really, get a chance to buy the home if you're not if you're able to wait for that to occur. And again, the part about that that's a little tricky is, as we just talked about earlier, the forecast from this seminar at least was low 6s in 25, mid 5s in 26. So to hit that magic number, and if you believe in my number, we're at least 2+ years away. Even if we believe the number given at the seminar yesterday, 5 to 5.5, we're still probably a year to 18 months away. So we still got a ways to go to see that magic mortgage number, that magic mortgage rate actually occurring.
Well, I'm just curious that if we do hit that magic number, and again, I'm gonna encourage people, if you're watching this live or before, go back and listen when Art said, because we talked about this, you brought it up, is like, hey, what's that number to get people to say, I have that 3% or less interest rate, but it's not such a big jump that I'll be willing to sell my home and move into something else, buy a new home. And I think you were talking about that breaking that 5% barrier back several months ago.
Yep, exactly right. I think it's a very, very important psychological threshold. Under 5, when you get into the 4s, in fact, frankly, just as a digress a minute, I've been talking to a home buyer, prospective home buyer, pre-qualified them. They're looking to make an offer on a home, actually probably today. And we were discussing buy downs, both temporary and permanent. And as we were having that discussion, they asked me about a permanent rate buy down rather than a temporary. And using the same amount of dollars we were considering them asking from the seller to fund the temporary buy down, they said, well, what kind of rate will we get for a permanent rate buy down over the 30-year term of the loan if we use that same seller credit amount? And I did the pricing real quick, and I said $499. Well, let me tell you, they got real excited about that. When they heard $499, their just emotional reaction was significant. They are really now contemplating maybe not doing a temporary buy down, go with that permanent rate buy down, because sounding, under 5% sounded awfully, awfully good to them.
Well, you've talked about the temporary buy down, and you just talked about the 24, 25 numbers. It's almost like you can buy now and use a temporary buy down, get that that unlocked number that you've been looking for, and then when it does change in 2 years, you're still in a great spot. I mean, it's like you've said, I don't know if exactly this, but you have all the aces. You've got both sides of the bet.
Well, right. Remember, we talked about the one-sided bet. If we're to believe these latest forecasts, like with the seminar yesterday, that we're going to be in the 6s pretty much all of next year, we're going to not get into the mid 5s until 2026. There are people out there who are waiting for the right time to buy. We keep saying, don't try to time the market. So what you have to do is, number one, just to clarify, by the way, because I know we had a viewer a few weeks ago thought that I was just trying to encourage people to jump in and buy, maybe when they're not really ready to, or maybe when they don't have a need to own a home. What I would want to clarify is make it clear that what I'm referring to is people who are looking for the right time to buy. They need to buy or they want to buy. I don't want to force anybody to buy a home when they're not ready to do that. But if you need to buy or you want to buy, and if we determine you're qualified, I don't see any rational reason why you should wait much longer, because that waiting game of lower rates or lower home prices just isn't in the cards, at least not over the next couple of years. And yet, in the meantime, what do we keep talking about? Home prices are still gradually appreciating. And so, if you're able to qualify for financing now, because remember, temporary buy downs are not a qualifying tool, um, I think now is a good time, knowing that the time horizon for lower rates is more extended than we thought. So therefore, look at getting a home now, use the temporary buy down, because one of the things that's happening is as that inventory is inching up, when we're over 4 months supply rather than 1 or 2 months supply, the shift in terms of who's got control, who's got the leverage. Is it seller's market? Is it buyer's market? We're definitely moving now to more of a neutral to buyer's market.
Mhm.
You have some ability to submit an offer and get seller concessions. And I think the best way to get that concession is get dollars from the seller, use it to fund that temporary buy down, 3-2-1 or a 2-1, and then use that first couple of years to enjoy that payment savings, that interest rate savings, and then look for that opportunity to refi that at this point looks like it could be as late as 2027. Well, 3-2-1, I think, is a perfect tool under that scenario. You're going to have a below market rate for 3 years that will take you into 2027. And if mortgage rates do get low fives or even better under five, timing would be perfect. Now, again, I can't make that prediction, may not happen, but I think it's a pretty good strategy to consider given all the data we're hearing currently.
Well, every week you give us the good news, which means bad news, or the bad news, which means good news. And so, as I'm listening to this, I'm like, okay, it sounds like really good news, but could be bad news if the rates go down. What does that do to this pent up demand that now it like breaks the dam and people go out and start buying homes? What's that going to do to home prices?
Well, yeah, and again, this came up in the seminar yesterday. The whole issue of pent up demand, and there was a couple of numbers that were thrown out that were pretty astonishing when you think about it. Number one, we're approaching 20% of folks aged 20 to 35 are living with their parents. That is a significant number of people, and those are people who are eventually going to be homeowners. That is part of the pent up demand that is sort of lurking out there, and probably waiting again for home prices to fall or for interest rates to fall. And then a couple other numbers that were quite astonishing, I thought, is over the next 10 years, they're expecting to see 10 million more millennial buyers and 17 million more Gen Z buyers. 27 million over the next 10 years, millennials and Gen Zs that are expected to or should be going into the housing market. And that is a substantial amount of pent-up demand, again, lurking there. Now, I would argue part of the biggest part of this problem, and I'm a mortgage guy, I'm going to defend mortgage rates. Historically, mortgage rates are not that bad. They're not that unreasonable at all. And when you compare mortgage rates to most other types of borrowing, the cost of borrowing for a mortgage is at the bottom or nearly so compared to all other kinds of borrowing, credit cards, unsecured personal loans, car loans, etc. Mortgage rates in and of themselves are not highly unreasonable. The real problem, the real boogeyman here, I think, in terms of housing affordability is the house price, not the mortgage rate. But yet house prices are holding firm. They're gradually going up. And so again, to the extent we have folks in this age range still living at home because they think they can't buy, I think they should talk to somebody like us. Let us determine if you are able to buy at these rate levels. And again, use this strategy of temporary buy downs or maybe a permanent buy down to negotiate some seller credit, because there is more buyer leverage now with inventory gradually going up, so that way you can get out of mom and dad's home, get your own place, maybe buy a house with a friend, as we've talked about, and then be able to have that ownership in place. You've got a one-sided bet. Once you get that mortgage in place with that temporary buy down, your worst case rate is fixed for 30 years. And then you still have that, subsidized payment schedule for the first 2 to 3 years, waiting for that refinance opportunity to occur. I think that strategy could not be better situated for other than what our current conditions are, really.
Well, when it comes to the current mortgage rates, I mean, is there a bright spot?
Yeah, there is. I think hopefully this period of time with the Fed in September, and then again this month and expected next month, between the September meeting, the November meeting, and the December meeting for the Fed, what is happening or expected to happen, and it's already happened to a large degree, the Fed funds rate is being lowered. If the 0.25% in December does occur, that means the Fed funds will be 1% lower than it was in August. So that is good news. That is a benefit for certain types of lending. As it relates to the mortgage market, what type of lending? Equity loans, both fixed rate loans and in particular HELOCs, home equity lines of credit. Why? Because home equity lines of credit, HELOCs, are tied to the prime rate. The prime rate is directly correlated to the federal funds rate. Again, the Fed funds rate is literally a overnight short-term borrowing rate among member banks of the Fed system. It directly correlates to prime. So if you are a homeowner that has a HELOC, you should have seen a 0.75% reduction in your interest cost for that HELOC. You'll have another 0.25% next month, most likely. So you've got a 1% improvement in your HELOC literally in the last 3 or 4 months. If you've been on the fence about getting a HELOC, I would argue this is good timing. And again, I always caution about timing the market, but frankly, at this point, it is good timing. Why? Because HELOC rates have already dropped, unlike that 30-year mortgage. And if you're a homeowner, you got a lot of equity, and you're hearing that mortgage rates are still going to be in the 6s for basically all of 25, not even get to the mid 5s until 26, that may be a reason why you'd say, okay, we're going to stay put. We're going to tap into this equity. Maybe we're going to remodel our house substantially, refurbish it. There's maybe other reasons you need to access your equity, but given the forecast for mortgage rates being at relatively close to these levels for the next couple of years, that's why looking at an equity loan or a HELOC, particularly a HELOC, because they're variable rate loans generally, although we have a very attractive fixed line HELOC. That way you can get that HELOC now, do those improvements, and you're likely going to see some improvement in the rate going into 25 and 26. Now, it's not going to be as rapid as we thought earlier this year. I remember one point mid-year where there was talk about, the Fed's going to lower the Fed funds rate 6 times in 2026. I would say it's probably more like 3 times. And again, it's very dependent on what the service economy is doing, what the labor market's doing. There's still some people who think that we're going to see a recession, a mild one, sometime in mid 25. But otherwise, getting a HELOC, a variable rate HELOC, could be a great option right now, given that we're going to be at higher levels on 30-year mortgages for a longer period than everyone expected. And just to give you an example, we could do, I've got HELOCs now where, your starting rate is under 8%. A fixed line HELOC, we're at 7.5%. We can do a HE loan, like a really good option is a fixed rate second mortgage, 20-year term at 7.5%. That is a tremendously good rate compared to where equity loans and HELOCs were just a year ago. Our Home Safe Second program, that's that reverse mortgage type product, that rate dropped from 9.99 to 9.49. It's a great product for senior homeowners who can't qualify for a HELOC, but they need to tap that equity, and then they have the flexibility of making a payment or not. That's up to them. They can make payments when they can for any amount that they can. And in the meantime, they're not required to make a payment. Yes, the loan balance will grow over time, but it's a great tool for those senior homeowners who've had a reduction in income, need to tap that equity, and need more flexible criteria to get qualified for the loan. And then lastly, I want to point out, folks who own rental properties, we've got both HELOCs and equity loans where now the rates on these things are literally right around high 8s to low 9s. That is terrific for a rental property. So again, HE loans, HELOCs, those are the bright spot in the current environment. And I would encourage any homeowner who doesn't already have one, has a lot of equity, needs to access that cash, in particular, whether it's remodeling your home, building an ADU, or consolidating credit card debt. That's something I think is sitting there waiting for you. You just need to move forward and check it out.
Before I let you go, Art, I just want you to do me a favor and tell me again what the temporary buy down rates are right now, especially when you've talked about that magic mortgage rate being, not acceptable with the 5 to 5.5, but you're saying under 5. What can people who listen to this say? Well, I would like to buy a home, but it's still too high. Are they below that magic number?
Well, they would be with the temporary buy down for sure. And one of the things, the one loan type that I think is a little bit underutilized, if you're going to be getting a conforming loan amount. So depending on what county you're in, a conforming loan amount is going to be somewhere in the 700,000 to 800,000 range. FHA, particularly if you're maybe looking to buy a home for your first time, you don't have that 20% down payment, which we always remind people you don't need 20%. You got to have good income, but you don't need 20% down. FHA is a terrific product to combine with the temporary buy down strategy. Why? Because the FHA rate generally is going to be lower than a conventional rate. Right now, FHA is right around 5 7/8 to 6%. So imagine with an FHA loan, you could buy literally a $700,000 home, put 3.5% down, use a 3-2-1 buy down if you can negotiate that with the seller, get the seller credit to fund that. You could have a first year rate at 2 7/8.
Oh my gosh.
A second year rate at 3 7/8. A third year rate at 4 7/8. You don't get to 5 7/8 until year 4. Well, again, based on where these projections are going for mortgage rates in general, it may be 2027 before we hit that magic mortgage rate in the low 5s or into the 4s. That timing would be perfect to then look to do the refi into a longer term, lower note rate. So, and in fact, the same borrower I mentioned earlier today that I pre-qualified for a purchase, and we talked about the temporary buy downs, they're looking at a VA loan or a conventional loan. Their credit score is okay, a little over 700. But it's not the best tier for a conventional loan. The rate differential between a VA loan with their credit score and the conventional at their credit score was 1%.
Wow.
And we could get them 6% on a VA, but because of their credit score for a conventional loan, it's 7%. So the 3-2-1 buy down it's a big difference. If you're buying down off of 6%, your start rate is 3. You're buying down off of 7%, it's 4. So the temporary buy down strategy is particularly good for FHA and VA loans, where you could literally get right at around 3% or possibly even into the 2s that first year. I mean, it's a tremendous opportunity that I think is not being utilized enough.
Wow, that's good news. Well, Art, thank you so much. I hope those people are watching, whether live or recorded. Reach out to Art. You can get a hold of him. Let me put his number on the screen real quick before I dodge out. And I'm going to give you a cell phone number because that is the hotline number. That's the one he's always answering, no matter whether he's playing golf or he's swimming or he's at the gym. He's going to answer that. That's Art Sell at 714-612-9035. I think before you decide, hey, it's off the table, it probably is one of those things where you deserve to call Art and talk it through and find out what your options are. Like, as an example, the people you talked about said, hey, what if we did a permanent rate buy down? What would that be? Like, that's a discussion you have where unless they talk to you about it, it would never come up in their mind about that, right?
Well, exactly right. In fact, when I first encountered them to do the pre-qual, they weren't thinking about buy downs at all, temporary or permanent. They were just looking for a loan, either VA or conventional at current rates. And so I'm the one who brought it up. And now that I have, their interest level has gone through the roof, and they're really excited about these options that they had never considered. And so that's really the point, is talk to us, call me. Let's just have a conversation so I can at least let you know what's available. And then, you can put that into your crystal ball and kind of talk with, your family or your spouse or your partner, whatever, and figure out if these are the right tools to use to take advantage of home ownership now instead of later.
Well, Art, thank you. This is great information. And again, those people seeing this, call Art at his cell, 714-612-9035, and take advantage of the bright spots in the mortgage market. Thanks, Art.
All right. Thanks, Jeff. Well, folks, actually, before I go into the closing question from last week, one other thing I want to mention is going back to the equity loans and the HELOCs. I did want to point out that we have really good HELOC options and equity loan options now for condos. We've got a more streamlined process. Condos can be a little bit more a challenge because you have to get additional documentation, like a condo questionnaire, which your property management company can charge several $100s for. Other condo docs that we might have to order that they charge money for. Well, our HELOCs and equity loans, we don't need to get that. I mean, we've got very streamlined. We don't need all that condo documentation. There's no rate adjustment for condos. With a lot of mortgage programs, condo property types cause an increase in the rate that's available. Not true with our equity loans and HELOCs. Then the other thing is we can do debt ratios up to 50%. A lot of HELOCs cap out at 45%. We can go to 50, and you don't need any cash reserves post-closing. We don't have to verify your liquid assets. So keep that in mind for any condo owners looking for a HELOC, and if you're running into any issues there, want a more streamlined process and better interest rates on your condo for an equity loan or HELOC, please give me a call. Love to have a conversation with you about that. So with that, I want to go to the closing question from last week, and here it is. We purchased our home almost a year ago and set up an impound account for property taxes. We recently received a supplemental property tax bill, and we're shocked to learn it won't be paid from the impound account, and we have to pay it ourselves. Why is that? This is a common question. A lot of homeowners run into this, so let me give you an idea what is going on there. A supplemental property tax bill is triggered after reassessment of the property. And that's usually going to happen when the property has changed hands from a sale. So what happens is after you've purchased a home, that transaction eventually is going to filter to the county tax assessor's office. They're going to look at that transaction and see what the purchase price is, and they're going to reassess the property value based on the purchase price by that new owner. And the issue there is it's going to be issued, but it can take a while. I've seen instances, believe it or not, where that reassessment and the resulting supplemental tax bill has come out literally almost 2 years after the purchase. That's pretty unusual. That's very rare, but I have seen that happen. The thing to understand is that the fact that because it's going to take that amount of time, and it's usually within the first year, your impound account's already been set up. The lender is going to disperse out of that impound account just based on the regular property tax bill that comes out. Certainly in most parts of California, it comes out usually late summer, early fall, because your due date is typically November 1st, and then it's delinquent after December 10th. So it's late summer, early fall when those tax bills come out, but only the general base tax bill is going to come out. The supplemental tax bill can come out at any other time. And again, it's going to depend on when you close your purchase, and it can be many months, maybe up to a year before it comes out. So when that does come out, I've seen homeowners who just think, oh, I have an impound account for taxes. I don't need to pay attention to this. And they just file it away, or who knows, throw it away. And then they find out later they're delinquent on their supplemental taxes. The reason is the lender, even though you have an impound account, does not pay your supplemental taxes. So when you get that bill, pay attention to it, make plans to get it paid and get them paid by the due date so you don't run into a problem later. And again, some of these assessments and these supplemental tax bills do not necessarily happen because of a purchase. It can also happen if you're doing any substantial improvements to your property, such as adding on a room, maybe building an ADU, a pool, and so forth. Because usually what happens is when that building permit is issued, that's going to trigger, again, the assessor becoming aware that there's something going on with the property, and they're going to reassess it, and there could be a supplemental bill issued. So again, pay attention to that, pay that yourself. It's not going to be paid by the lender. You can't send it to the lender and say, pay it out of my impound account. They don't do that. And again, rare instances I've seen really kind of a bad situation where that supplemental bill doesn't come out in timely fashion. I know of one case here in the Valley, this a few years ago, they didn't get their supplemental tax bill for almost 2 years after their purchase. In the meantime, the tax bill was still being reissued based on the previous owner's value, which was much lower. And so they actually ran into a case where they had too much money in their impound account because that reassessment never got done in a timely fashion. And when there's an excess money in your impound account, the lender is going to refund it to you. So they ended up getting this refund, thought they were fine, cashed the check, used the money, and then later when that reassessment did finally get done and the supplemental bill came out, then their impound account was short and they had to go through a substantial increase in their payment to get it all caught up. So be careful with supplemental tax bills. They are a little bit tricky, but understand they're your responsibility. You need to pay them yourselves. They're not going to be paid by your lender if you have an impound account. So a good question. Hopefully that helps understand that process and help you avoid any kind of messy situation that can sometimes provide to you. With that, I'm going to go ahead and close with our closing question for next week. Here it is. We have a significant amount of student loan debt that is deferred, and we're considering a home purchase. How is this debt accounted for when qualifying for the loan? Well, I'm going to cover the answer to that question. It'll be on the house, and it does vary depending on what type of loan you're going to get, conventional, FHA, VA, USDA. So I'll cover all of that because you might be surprised on how each of these types of loans treat those deferred student loans in terms of monthly payment and qualifying differently. So again, we'll go over that next week. In the meantime, I want to thank all of you for watching and listening to this week's Mortgage Minute. I hope you have a great weekend coming up. And of course, have a great Thanksgiving week next week. I think we can all be grateful for what we have. And so that'll be a time to get together with family and show our thanks. So in the meantime, so long and take care.